All right, everyone, welcome to the long and short of it. Another episode where Nick and I are going to take a deep dive into options. I always love talking options with you, buddy. Welcome.
Likewise, Patty. How was the new year?
Oh, it's great. I'm settled in here in Mexico. I was over the New Year's out in Medellin, Colombia, where George Gammon was hosting an event, and it was just awesome. Loved it out there, but settled in here in Mexico, ready for an interesting month here in January. You know, Nick, let's just talk a little bit about where we are in this market, because one of the interesting things that's happened here was that in December, we actually had an underpinning market sell-off that was happening at the same time as there was these Mag 7 stocks that were ripping. And so the S&P seemed like it was flat. There was this huge bull market in the Mag 7 stocks. They were ripping higher. But we got to a stage where the breadth of the market, based on, let's say, the percentage of stocks above their 50-day moving average, deteriorated under 20%, which basically means 80% of stocks were in a downtrend. It was a really, really tricky market. And so now all of the gamma pinning, all of this momentum, year-end kind of window dressing, everything that's associated with the year-end stuff is gone. Here we are, first few days of January. Like, first of all, what do you think is going to happen here? What's your kind of thoughts on the market?
Well, I think we're going to see a lot more volatile uptick as we approach that inauguration for Trump, which is only, we're only 13 days away from that, 2 weeks away roughly. And we're already seeing a little bit of VIX spike right now. Sorry, a little bit of dyslexia there. But right now, like, the big guys are carrying the weight of the market. Like, you know, we saw Nvidia yesterday, for example. Like, they accounted for 16 of 32 of the points in SPX. So half of yesterday's rally was just Nvidia. Meanwhile, overall, the breadth is negative. Like, yesterday we saw 267 stocks down and 232 stocks up overall. Right, so we're seeing the VIX higher. With the spot price up as well, right? Which is, to me, a foreboding of perhaps a bit of a caution going forward. I would say that we could see a test of like that 5,600 area on SPX, which seems pretty far fetched. We're about roughly like 7-8% away from that area, but I think with Trump coming back in and what he brings to the table in terms of these out of left field announcements, we're going to see a lot more volatility ahead.
Absolutely. You know what? Let me just put up this chart of Nvidia, because it's got to be talked about. Like, you see that gap yesterday higher. The thing was for a full double top retest of its $150 highs. But look at it getting slammed today, giving everything back and more. I mean, we're almost back down to the 50-day moving average and only like $10 away from its lows from December. Like, just talk about a massive fake out on the upside. And this is critical, because if we're seeing these Mag 7s starting a big topping formation, if we see double tops and all these other types of technical formations that are associated with distribution, that it'll be very hard for the rest of the stock market to keep the indice higher when the Mag 7s are selling. The S&P is just weighted so heavily, and the NASDAQ 100 is weighted so heavily into these Mag 7 stocks that if they turn, the whole market is going to go through a sell cycle. It'll be really interesting. All right. So listen, bud, I mean, last week or a couple weeks ago was your turn to present a trade. You built a little thesis on AMD. As far as I checked, the trade's flat right now. Any thoughts on it quickly you want to comment? Because I think we can save it for an episode a couple weeks from now to see if something's happening. But is there anything you want to mention on it?
We still have about a month or so before expiration, February OPEX. And really the catalyst here is going to be earnings. My thesis was that we're going to see a run into the earning event. Already when we mentioned this trade, it was like 125-ish. We're at 128 or so right now. We hit a high this morning of almost 132, at which point the trade was up about 30% almost. Yeah. But the point is that when you're trading these ideas longer or mid to longer term, if you are going to take profit on, a smaller gain, for example, you have to be consistent with how you're taking your losses as well. So for example, this morning, if you're up 30%, you say, you know what, I'm going to take profit here. You have to be taking losses of commensurate value as well. So you might take a 10% loss, for example, to try and keep your consistency overall in position sizing. Otherwise, long-term trading, it won't work out for most people because they don't act consistently overall with taking profit and keeping the sizes of losses relative to the size of the profits as well, right? So my target here is somewhere around 140-ish, start taking some off into earnings. Earnings may be a catalyst for me to take some off prior because, again, it's about a binary event. I might be nervous if we're still far away from my long strike into the earning event. So for example, if we pull back down to like 120-ish, I might think about just stopping out and maybe rolling forward to March or finding a new trade, for example, right? But as it stands right now, not much has changed. Stop loss was not hit. Profit target was not hit. So it's just status quo, just pretty much patiently waiting for something to happen. That's it.
Awesome. Well, listen, let's. I have a trade idea today, so I'm going to present. And what I love about doing this options podcast with you, Bud, is just that you have this kind of trader, gladiator right in the pits, fighting for every profit in this active game. I, on the other hand, love to kind of play these bigger, longer term theses and use options to construct longer term trades. And so for today, I wanted to do a big long-term story, and the one I want to talk about is Boeing. And now, if obviously listeners know that back almost like 3-4 years ago, there were airplanes falling from the sky, and Boeing was just taking some serious abuse. In fact, here, let me just show the chart here. I'm going to put on a weekly, but you go back to basically 2020, and you can see where the stock went from $450 down to $100. Like, we were talking about 75-80% of the value of the stock was wiped out in just 1 year, and it was a devastating hit for Boeing throughout that cycle. And since then, Boeing has been pretty much dead. It's been in a more or less a 4-year, almost 5-year period where it's just grinded in a sideways range. Now, the stock has been left for dead. A lot of investors basically have allocated money to things that are working, right? Like, you basically aren't going to sit there and grind it in a stock that isn't moving when you're in the middle of a big bull market. But there is some really interesting ideas toward this, because I think that for all of the things that have gone wrong in Boeing, Boeing is one of these stories that is going to be restructured and is going to continue to be a key component in the U.S. economy. Like, I want to just kind of go through. I'm going to say a couple of obvious things, but one, Boeing isn't going to go bankrupt, or at least they're not going to let it cease to exist, right? Because Boeing has strategic importance to national defense, right? A huge critical role in producing military aircraft, satellites, missile systems in a time where the U.S. needs to remain dominant in that space. At the same time, from a geopolitical perspective, from competition, if Boeing was allowed to fail, it would allow its European competitor Airbus to take monstrous market share, but it would leave a huge gap that would allow China to step in with its own aerospace program and start producing to fill that gap that would be left behind if Boeing ceased to be making planes, which, by the way, I don't think is going to happen. Yeah. And there would be the industrial impact, which would be, it's not just all the jobs and employment that Boeing creates, but there's critical suppliers that feed Boeing. There's an entire huge economic kind of system built around it. When you have someone like Trump coming in here who wants to protect the industrial complex in the U.S., the bottom line is Boeing ain't going anywhere. So really it becomes a story of it becomes a story of how long will it take the stock to turn around. So I want to just talk about another turnaround story as to create an analog, which is General Electric. GE was similar. I'm going to put even on a monthly chart. General Electric went through a vicious bear market decline. From its peak of $300, it went down to trading at 30, like 90% wipeout of the stock over a vicious bear market. It went through also about a 4-year restructuring, a period where they redefined themselves as an aerospace company. They had to redo everything, restructure themselves as a business. Ultimately, when that restructuring period ended, the stock went on a 400% rip to the upside. It was an extraordinary bull market when it finally turned. But for 4 years, investors were incredibly frustrated, disappointed, uncertain of what was in the future of the company. I think a turnaround story like this in Boeing is not out of line. I think at some juncture, Boeing is going to start to actually do well and move higher. But this is not something you could play with a 3-month play. You can't go and put a 90-day option on a large, long-term turnaround story.
Yeah.
And this is where I want to talk about the use of long-dated leaps or long-term options as a way to construct a asymmetric trade that allows you to play this thesis with a definable downside risk and have upside potential that is extraordinary. Right. And so I want to talk about different ways to put this on. And obviously, I'm going to end with one interesting way that I think the trade could be implemented. But I want to start off by just speaking to the investor who says, well, look, I love what you're saying, Patrick. I also believe this, but I just don't feel comfortable using options per se. I would love to just actually physically own the shares and own this as a long-term investment, right? And this is a no-brainer, easy way to put the trade on is to actually simply hedge out the downside risk of Boeing long-term. So let's say somebody was buying, let's say 100 shares of Boeing, and you're outlaying 17 grand to buy 100 shares. And so you turn around and physically buy the shares at $174. What's interesting is you could buy 10% below where the stock is trading, right? You could buy a protective put for 1 year for $15, or you could buy a 2-year put for 21. And so now this is an insurance policy, right? When you buy a protective put against the stock, it is securing you a guaranteed sale price, a price which you can definitively sell the security at. Yeah. And therefore you can override things like the need for diversification. You can take the trade with high conviction, size the trade, even concentrate it, as long as you accept the worst case scenario. But what I love about the trade, Nick, is you know exactly how much you're going to lose if everything goes wrong, right? If you're dead wrong, let's say they allow equity investors to get zeroed, and they do a restructuring where they convert the debt holders into new equity and do a big restructuring in some sort of Chapter 11 state. The company can continue, but there's always a worst case scenario. But I'm going to assume that the current company is on track for restructuring everything and making things work. And if that's the case, this limits your downside risk to about 20%, right? 10% before the insurance kicks in, and roughly about another 10% of the value to buy the insurance. And therefore, in the worst case, over the next 2 years, the worst you can do is get drawn down 20%. Now, to me, this is an interesting proposition because, as an example, in just 90 days, on numerous occasions, we had drops where Boeing lost, like this was $160 drop in a year. But let's say even just this drop over here from its peak to trough was about a 50% wipeout of about $130. And even on a daily chart, the last 90 days saw a drop of Boeing of about $60 or 30%, right? The point is this is a very volatile stock. Mm-hmm. So when we've seen these monstrous percentage drops, think about it. That's a 30% drop in 90 days. But we've created a trade that over 2 years, the maximum you can lose is 20%. Right? Like, so you've massively created, you made a trade that basically allows you to have all of that downside risk completely defined to something that you can accept this risk.
Yeah. I mean, looking at this overall, one idea that crossed my mind looking at the option chain was the same expiration date, so 2027 January, and looking at the 150 strike puts, which are about 1720 right now, and the 250 strike call options, which are about 1750. So in a similar vein, obviously this wouldn't be a purely option-based trade, but let's say, for example, you bought the stock right now at spot price, which is 17,400 roughly per 100 shares, and then you sold the 250 strike covered call for 1750, and then you bought the 150 strike protective put for 1720, giving you a credit of about 30 cents roughly. Your downside would be roughly the same, about 20%, with upside of essentially, based on your risk, upside of about 300%, up to 250, right? So similar kind of idea, but obviously, like, you're owning the stock in this case, which is maybe not the most capital efficient method of trading this, right? Because you're buying the stock, it's
Yeah, well, capital efficiency, like ultimately those investors that want to invest into the turnaround story of Boeing, and this is a mechanism from which they can define their downside risk, right? So, I know your brain works as risk reward payoffs for trading purposes, but a lot of times the part that makes it difficult to hold a long-term thesis like this is that you have this long-term story that you highly believe in, but when the stock loses 30% of its value in a very short window of time, you start to second guess things. And from a pain point perspective, a lot of people will succumb to stop losses and or simply just bail on the trade just because they can't stand seeing all the red. What this hedge does is it allows you to say, I already know where my exit is. I already know what my worst case is. And so I can hold it. But like, think about it, like General Electric after its turnaround did a 400% run on the upside. And that's not an option. That's a 400% on the stock. And so the point being that, if you can define your downside to 20%, Boeing can, if the turnaround story over the next 2 years is legit, can easily be a double. You could build this payoff profile where you can have 100% run on the upside of the stock and it'd be limited to a downside risk of 20%. And that kind of asymmetry is something that always makes most investors interested. Now, the alternative, of course, is if you want to outlay far less capital, is to just buy a call. And I wanted to talk about that as an example, but I realized I just wanted to mention one last thing, because I think a lot of our listeners may appreciate wanting to understand why is it that a 1-year hedge costs $15, but to hedge 2 years out is only $21. Like, it literally isn't linear. It isn't linear that, 15 for 1 year, 30 for 2 years, right? Like where you would naturally extrapolate. Why is it that hedging for 2 years is distinctly cheaper than hedging for 1 year? And the one biggest factor, there's a number of factors in it, but the one biggest factor is interest rates. And because in option pricing, pricing, there's this variable known as one of the option Greeks is rho, because in the option pricing model, interest rates are being discounted into an options price. And so with today's option interest rates being up at 4 or 5%, when you're discounting that 2 entire years forward, the put option is actually that much cheaper. The carry is actually making it cheaper. So it's actually, from a perspective of insurance, it's actually much cheaper to buy that longer dated put. And so it is. So in that circumstance, do you decide to buy insurance for only 1 year or 2? You can see that as long as you're playing the big picture thesis, there's no reason not to just insure it for that long-term play. Yeah. Now, what I wanted to talk about is those people that just say, well, why don't I just not buy the stock and just buy an at-the-money call option for just knowing that, look, if the stock could go 100% in the next 2 years, if the turnaround story is a success, why don't I just buy a call? Don't put out all this money, $17,000 per, 100 shares. Why don't I just buy a call option and participate on the upside? Well, notice here, a call option at the money is about $40, right? Give or take. And so you're talking about outlaying $4,000 to have the 2-year upside of the stock. Now, that's not cheap, but it is as well a very definable risk. And you can alternatively outlay far less capital. It's like leasing out the stock. That's your lease cost. Yeah. And you have that upside, but it is a very expensive call in general. And so it is definitely one of the choices. But the way I was gonna present the idea of how to put on a turnaround story is actually with a debit spread, and I want to reference this because to outlay here, the unlimited upside is outlaying basically $4,000 or essentially $40 a share. But what I want to talk about is the idea of constructing a bull call spread between the $200 to $260 strike. So if I put it on the chart here on a weekly chart, that's basically for the next 2 years, looking for the stock simply to return back to the levels where it was trading just 90 days ago.
Yeah.
Right? Like it's not like a crazy thought that this stock, you have a 2-year window for this to happen. And essentially you're betting that this stock will return back to where, not 90 days ago. Sorry, that was a year ago that it was trading up at $260. So the question then becomes, how do you construct this trade and how much would it cost? And so when looking at a bull call spread, so what is a bull call spread? Again, it's the purchase of a call option and subsequently the sale of a higher strike call option to earn an income to reduce the overall cost. And therefore, you only can profit from the spread, hence the name of the strategy, which is, in this case, when we buying a $200 call option and selling a $260 call option, we are creating a $60 wide spread. Now, you do this strategy on very short time frames, looking for quick moves, but why not consider this for a long-term play? And so here, for a $60 wide spread, it can be pretty much opened for around $15. Mm-hmm. And so you're talking about having 3 times the upside for the capital outlay. You only have to put out $1,500 for the trade, and if it comes in, you have the potential of it being worth as much as $60. And so, to me, for those traders and investors out there that love this turnaround story but don't want to tie up huge amounts of capital in buying the shares, or don't want all of the volatility of buying a big expensive call option that is theta burning outright, this debit spread is a really interesting way of putting this trade on. What are your thoughts?
So 2 things. One of them is that if it were to run, for example, heavily, very, very in the very, very short term, position wouldn't be trading at maximum profit. So kind of like I mentioned with the AMD trade, which is a call spread as well. The option there would be then, if let's say, for example, there's a big turnaround, it ran to like $300 per share. Now it's fully in the money, but you have, let's say, a year and a half left till expiration, at which point it's not trading anywhere near maximum profit. Again, there's two options there, really. One of them is take your profit on the current position and roll it to a higher strike spread, for example, because at that point, you're no longer risking 15 to make 45. You're now risking perhaps 45 to make 15. So at that point, maybe you take 45 overall, which is $30 profit, and you roll it into a new spread, assuming you have the same thesis, and you see more upside ahead.
Yeah, odds are just so the thing, like if this stock was trading in a very short window of time, let's say a half a year, on a 2-year out position, only 25% of the time in, this spread might have gone from being worth, let's say, $15 to maybe actually just being over $30. It might be $35, maybe if you're lucky, $35, $36. You'd be probably up 100%,
100%,
on your capital, and you would need to hold it for another 18 months to potentially realize the full gain of the spread, right? You have to go the full duration. So I just wanted to reference that. So go on with your thought.
Yeah. So with that in mind, like, would you want to wait an additional 18 months to realize the additional, $25 to $30 of gain? Probably not, only because your asymmetry of risk is dynamic. It's always shifting, right? So at that point, you could, take profit and roll it to a higher strike, for example, spread if you wanted, or you could sell an out of the money spread, like way out of the money. Let's say it went to $300, for example. You could sell like the 350, 400, or the 400, 460, depending on what's available strike-wise, to recoup some credit to lower your overall debit. Let's say you were able to recoup $10 on a out-of-the-money spread. Your initial debit was 15, so now you're risking 5 to make 45 overall, and then you have a pocket between like 260 and like 400, for example, which will give you maximum profit. Again, it requires you to just pretty much sit in the position and wait for 18 more months to realize the full profit. So there's many different ways to skin this proverbial cat overall, right? Yeah.
I think one of the simpler things you could always consider is that if in a rapid fashion it did proceed higher, it gives an opportunity to parse them off, take the initial principal off, and reduce the position. Because then, let's say you're up 100%, and let's just say tactically sell half the trade, just so that you've taken all your original principal out of the trade, and now you've got the spread that's open, that basically is nothing but profits riding. And if this thing 2 years from now comes in, you still make a couple hundred more percent on the position. But by taking your original principal off and putting it in cash on the sideline, if Boeing over the next following 6 months gave back some in a retracement and pulled back, you have all your original principal on the sideline to put on a brand new trade in addition to the one that you already have open. And so one of the reasons I prefer that, Nick, and again, this is what makes the two of us it really shows how each trader has its own unique way of approaching trading. And that's what I love. To me, I never want to lose my original position, because psychologically it's like I made this call on Boeing. I got in originally at this level, and it's sort of like a starting position, like an anchor, that kind of like a pillar to the thesis. What I find, at least for me, it's challenging, is that once I close that trade to reopen a new one, it's almost like you're mentally resetting the trade, and you lose your anchor as to what was the original thesis when you originally got in. And I find it easier for me psychologically, and it's more psychological than math. It's about the psychology of, look, I made a call on Boeing. There was a big thesis on this trade. I went out 2 years on this. And so I feel like I almost want to keep a part of that original trade always on, so that I have my kind of pillar, my anchor to the trade. And then you're always willing to kind of take a little off when it's working on a pullback, open another leg somewhere to kind of take advantage of a new move, and just and trade around it. Anyway, that's the way I kind of look at it.
Yeah. One more thing too is that, let's say for example, Boeing pulled back down to like, I don't know, 120 or so. At that point in time, if you own the 200, 260 call spreads for 2 years out, one thing you could do as well is you could buy back the 260 strike. Now, obviously, that'd be increasing your overall risk. But if you were still bullish and your thesis remained intact on a pullback, you can kind of trade those options by essentially buying back, realizing a partial gain on that short call option, and then reselling it if it popped back up again, right?
Well, listen, I love your story. I want to keep talking about this because
I know.
Okay, I know this is wicked because let's talk about actually the way that the spread will behave. Here, let me just pull up a chart here of Boeing, right? So you're talking about a scenario where, let's say that this stock goes and has another leg down. Let's say there's another full market washout, and this thing heads in the next leg down to $120, and this thing is now trading all the way back down to its major lows that is over the last couple of years. Well, this spread, let's say in a 6-month window of the stock declining another $50 like this, would have gone probably from being worth $15 to probably worth $9. You're talking about like a $6 drop in the value. Now you could look at it as a percentage wise, but think about it. The stock freaking wiped out $50 to the downside, and your trade's down $6.
Yeah.
Right? Now, what does that give you the chance to do? Well, you could close that entire spread at a loss, the 200 to 260, but now you open a 150 by 200. Now what you can do is for a $5-6 loss, you can bring the whole spread down. It's kind of like getting a mulligan in golf. You get to reset the whole trade at a more favorable level, even though you were wrong about your timing. And now the thing goes ripping from 120 just back to 170, and you're freaking making 100%, right? It's one of these scenarios where the flexibility you have in the trade when you're wrong is one of the more interesting benefits of putting on a spread trade, just because you are short an option against a long. So what you're losing on the long option, the short option is actually making you often in similar profit, or at least there's that inverse correlation of the two, which allows the overall volatility of the portfolio to go down, right?
Yeah. I mean, that's the great thing about options is really they allow you to be dynamic in your positioning, right? And one of the pain points that most investors face is, I remember when I was in university, one of my profs who was a fund manager told us that on March, I think it was 6th, 2009, the very bottom of the great financial crisis crash, one of his top clients came in and demanded that he sell everything, and he implored them not to. And they ended up selling everything at the very, very market bottom, and then watched it double in the next few months. And they were devastated because they missed out on all those gains. But the problem with most investors is that the pain tolerance on a decline is not very high. Like the more money you have at stake on a given position, percentage-wise in your portfolio, the less pain you can tolerate on a downside move. And with options, by having that capital efficiency, having the asymmetry of risk, that allows you to really withstand those painful moves to the point where you might say, you know what, I risk whatever 2, 3, 4, 5% of my portfolio in this trade. At worst case, I'm going to cut it for a loss of 3% overall, which could be a decline in broad markets over the course of a couple months off of a high, for example, right? And then not only that, but as you said, you have the ability to then reposition and maybe buy some or a new position at a lower price point, giving you a higher probability of making a profit and possibly giving you a far, far greater outcome on the overall trade, even though you lost the initial one, perhaps.
All right. So listen, Nick, we're going to run short on time here, but what I'm going to do is I'm actually going to place this 200 by 260 spread. Because this is a sim account, I'm just going to come in here and place this at market legging in. And what we're going to do is we're going to track this thing. Let's let's watch this over the next year, and what we'll do is we'll see where the tactical adjustment periods are, the way that this spread behaved. But we're gonna track it. The sim at the prevailing mark is 31.40 for the buy, 14.69 for the sell. So closer to $17, $1,700 outlay for a one contract spread. But we're going to put it on with this debit spread, and that way it gives an opportunity for our listeners to watch how this trade plays out in the next little while. Any other closing thoughts, Bud?
One small idea would be maybe add a second contract there. This way we can kind of show them if it doubles in value, for example, preemptively, we could cut one position and show how it actually works overall, right?
So, okay.
I would add two contracts. Yeah.
Good call, Bud. All right, so I'll double this up. All right, so listen, we're in on it. Let's see whether the Boeing turnaround story happens or not. That's what I have today. But anything else you want to say?
I would just say, as always, guys, manage your risk. Have a very happy New Year, and we'll see you guys in a couple of weeks.
Absolutely. Look, I love doing this show with you, buddy. Let's help everyone with the options, and have a happy New Year, everyone. Cheers.
Absolutely.